Our panel has a comparative focus. For this, at this moment in time, that orientation seems to me compelling when there is a great deal of uncertainty of in terms of what's happened to your own system, the ability to look at other systems as a distant mirror through which to view your own is a model of sorts and one that isn't easily substituted for. What we're going to do in conducting the panel is move by alphabetical order as shown on your on the schedule. We'll do the coordination between speakers through the questions and answers through the questions and answers that follow. Each speaker will take about 15 minutes, which will give us plenty of time for questions before lunch. Professor Ito, would you like to start?
Thank you very much. And this panel has a Japan in the session title, and you may be wondering why Japan is in this conference. And the reason is that Japan is the country where the futures market was born in 1730. And this is the world's first futures market. And let me throw in some sociology knowledge, which I have, that in 18th century, Japan had four castes. The top caste was samurai. The second was the peasants. And third was the artisan, which is manufacturers. And fourth was commerce and finance people. So the 18th century Japan knew that the finance does not make any social values. That's why they are at the bottom of the caste. So the samurai tax peasants by rice. So the peasants have to bring the rice to the samurai. And some of them, samurai ship to shogun in Edo. And some of them they consume, but they have vast amount of surplus rice, which they sent to Osaka, which was a commerce center of Japan back then. And so every fall, summer to fall, they have the ships carrying rice coming to Osaka, and they put into the daimyo, the samurai warehouse, and finance people started to, buy and sell. There are a lot of demand for rice for the non-farmers, and they all wanted to buy. And spot market was born. Spot market for rice was born. Years later, they got smarter. So ship is on the way. So let's trade rice on the ship, which will come to the warehouse in 2 months. So forward market was born. Then they got smarter that let's trade those rights to get the warehouse rice, let's standardize. So there are different kinds of rice from different parts of Japan. They chose standardized rice, and they started to trade in exchange where those margin calls were created, and those maturity date was created. And so on. So the modern futures market was born in Osaka as rice certificate futures. So this is the financial futures. Okay. So 1730, the shogun in Edo approved this institution. So it was Osaka, Edo was the shogun capital, but commerce it's like Washington and Chicago, right? So the Washington approved Chicago futures exchange. It's like that. So although it was not socially productive activity, shogun must thought it's good to make people happy. Okay, so fast forward, 2005, that the Tokyo Commodity Exchange applied to have rice futures in Tokyo Commodity Exchange. The Ministry of Agriculture denied the application. rice is such an important commodity that they control how much rice should be produced and how much rice should be circulated in Japan, 2005. So they denied it. So the bureaucrats in Tokyo now is much backward, worse than the Edo samurai 1730. Okay? So that's an introduction. Okay, what I learned in the first session is the following. Okay? First, history is short. So no true correlation can be calculated. Second, a fat tail kills a fat cat. Third, a copycat will kill you. That your model becomes successful, then everybody imitates you, and that kills your opportunity eventually. So the fourth, the liquidity dries up if all moves in the same direction. So cat becomes thirsty when water disappears. Fourth, cat's memory is short. So they make same mistakes every 10 years. 1987, 1998, and 2008. So every 10 years, you have a crisis. So the conclusion I drew was the judgment of executive is most important. And don't blame a model. So that's what I learned. Now let's try to think why Japan, in this crisis, did not go into a crisis, financial crisis. All the Europeans were affected and so on, but Japan seemed to be holding up well, at least the financial markets holding up well. Well, there are two hypotheses. One, Japan was so advanced that they understood the risk and they didn't touch it. Second hypothesis, they were so behind that they couldn't touch it. Okay, so I don't know which way is right. Some people say that, but another way of putting it is that, which is neutral somewhere between the hypothesis A and hypothesis B, is that they still remember what horrible things they had to go through in the 1980s. So memory is short, but the Japanese crises were more recent events than the LTCM and 1987, so that they are still in the very, very cautious mode. The same executive is still in the top who experienced the banking crisis and so on. One episode, which I think I can repeat it, but without names, is that one institution, Japanese institution, who held the toxic assets, got rid of those assets in the very early stage. So I talked to the guy who was responsible, and he said he smelled something very fishy in the subprime December 2006, which corroborates with what we heard in session 1. And he immediately told the staff, sell it at any price. But of course, you have to do it gradually. By September 2007, they got rid of them all at fire sale price, probably 70% of the dollar, 70 cents a dollar. And I asked him, how could you make that quick, smart decision? And he said he still remembers what a non-performing loans problem, horrible things were in 1980s. So I think it's good to have the executives who experience the crisis for long time, and don't give them bonus and retire. Keep them in the top position and keep telling crisis story. I think that's the keep the history in the institutional memory, I think is a very, very important things. So the Japanese banks and the securities firms and insurance firms somehow avoided this crisis, and some attributed also not only the memory, but the regulatory regime, which was revamped in the aftermath of the Japanese banking crisis of 1997. So FSA was born in 1998. And they have, it's a integrated single regulator like UK FSA, and they took them 5 years to really shape up this examination and enforcement division, but they succeeded. I think that this is one thing that Japan did right in the banking crisis history. And they really try to examine the risk management of the financial institutions, and they adopted Basel II very early, much earlier than the US. And in the Basel II, there are sections that you have to see through the underlying securities from the securities what you have. So that is corroborate with the hypothesis A. So I don't know which is right, whether Japan was so advanced or Japan was so behind that Japan avoided a crisis, but probably some combination of those two hypotheses. Thank you.
Thank you. Jacques?
Should I go next? Well, first of all, I'd like to thank Kent for his prediction that chief risk officers are going to have a lot more power. May the upper powers hear him. I'm not going to talk about Japan because I have very little knowledge of that country, but what I'd like to talk about today is a number of presumptions about why certain countries might actually do better, and what are the types of things that went wrong, particularly in the U.S., that might not have been replicated elsewhere. And I'll actually use my home country as an example for a number of these cases. I'm originally from Belgium. If I look at one of the things that distinguished in particular the real estate market and how it functioned in Belgium versus the U.S., is that there are a number of the factors that affected the U.S. market that were never present there. One is, clearly, if you look at the press in terms of the contributors to the crisis in the U.S., people talk about extremely accommodative monetary policy. We know that. You need low interest rates to fuel bubbles. But you also needed an environment where a significant loosening of underwriting standards was going to take place. And if you actually look at a number of foreign markets, that did not happen. Had somebody walked into a Belgian bank saying, "Hi, I'm Joe Schmo, I'm not going to document my income, and I'd like to buy a house, and please give me 100 cents on the dollar," they would have probably called in people with white robes and have you taken out of the bank. Clearly the loosening of these standards created an environment in the U.S. Where the underlying economy actually started to have structural imbalances as well that were not necessarily replicated elsewhere. And to tie this a little bit into models, you sort of have to go back to some of the decisions taken a long time ago that might have motivated the change in how the financial services industry is actually operated. And one of those is sort of the movement from sort of issuer and holder to financial market intermediary, and it's a sort of the underwriting model versus the lender model. Again, something that was very symptomatic of the U.S. A large number of banks became basically underwriters, and lost the sense of fiduciary responsibility that actually was not necessarily codified. I don't think anybody ever said that a real estate lending officer had a fiduciary responsibility to the borrower. But in a number of countries, it actually did function that way, and it functioned that way, probably in the U.S. when you went to a smaller local bank who would have only ever given you a mortgage if they knew you, your grandparents, and your great-grandparents. So that change had a very significant impact. And if you go a little bit further back in time, you start thinking about, well, what are the things that prompted this? And one of the contributory factors was the requirement of capital requirements for certain types of businesses and penalties that would be imposed on holding risky assets. So it all ties in. So not to say that the regulators are using models that contribute to this as well, which is something I actually do believe, and I think is one of the big risks that we still have even in a recovering environment, is that some of the lessons learned about how models actually get used still need to be somewhat internalized. There are everybody sort of has complaints about Basel II and how it's implemented, et cetera. And there are clearly components of models that get built in financial institutions that, to anybody with a little bit of common sense, sort of, has people raising questions. I went through the exercise a few weeks ago of talking to our own people who've developed the internal capital allocation model. They were presenting results with relative returns on risk-adjusted capital across businesses, and there were reasonable numbers: 3.6, -2 for a business that's not doing well, 6.8, et cetera. And then I come across a business line that has a risk-adjusted return on capital of 59%. And my first reaction was, there's the next blow-up, guys, because there's something wrong with that number. And what's wrong with that number is, well, the return number is probably correct because you've measured that correctly. But it basically means that you haven't captured the risk correctly. One of the things that characterizes these models, particularly the ones for business losses and operational losses, is that they rely exclusively on historical data that's to a large extent internal. So if you move from the previous panel where we're talking about sort of market data and creating pricing models and value at risk models, et cetera, but you move to the realm of operational risk, you now get tiny samples, and samples that are actually potentially even smaller if you're really good at what you do. So if you're really good at what you do, you're going to have huge risk-adjusted return on capital numbers, but that doesn't mean that there's inherently not a lot of risk in what you do. You are either very good or you may have been lucky, or both. And if the same sort of rule applies that I think a previous speaker mentioned about how long it takes to figure out whether you're a good stock picker or asset allocator, it may be a reasonably long time before you figure out whether there are any significant weaknesses in your operational model. And by that time, usually it's too late. So, just a comment on sort of, where these risk models can affect, the behavior. So, loose monetary policy, relatively weak underwriting standards, the effect of models basically meant that, in the case of the U.S., there's significant more connection between what happened in the real economy and what happened in the financial services sector. Belgium on that front is an interesting example because coming into the crisis, there were three large Belgian banking institutions: Fortis, KBC Group, and Dexia. And what's fascinating about how they came or did not come well out of the crisis is that their underlying Belgian businesses sort of applied those traditional rules of strong fiduciary responsibility, sound business practices, et cetera. But they had significantly larger trading arms that basically ended up buying a lot of U.S. issued.
Correct.
Yeah, basically, yes. Thank you. I was looking for the word in a sort of politically correct way. And, it begs the question of, what traders in Brussels sort of had anything in terms of knowledge about sort of, U.S. CDOs and the likes. And, you come out of the crisis and essentially Fortis has disappeared and is now owned by BNP, and KBC and Dexia would not exist if not for, significant help from the U.S., from the Belgian government. So you had a disconnect between the two, and there's lots of other examples of these disconnects. I think everybody's read the story of that little town in Norway that basically, securitized income from a hydroelectric dam and decided that, they needed a little bit more income to provide their inhabitants with a better standard of living, and decided to buy U.S. mortgage-backed securities. And, that was a reasonably bad trade in the long term. Real economy, financial economy, I think that, if you look at a number of these economies, how well they fare in this crisis is somewhat linked to how effective a separation between sort of their domestic market they had versus their financial market decisions. The last thing I want to talk about was, is it over? And what are the risks that we are still concerned about? One of the things that was not talked about earlier on in the whole model discussion is something that was very problematic for people who were in the markets over the last 18 months, was that the assumptions that are built into the models have been criticized, and we can talk about normality and a whole other series of assumptions that are being made, but we often forget the basic one, is that you actually have functioning financial markets. And we had a number of cases over the last 18 months where the markets were actually not functional. And there are still significant parts of the U.S. market that are non-functional. The U.S. mortgage market would be essentially non-functional were it not for the intervention of the U.S. Treasury. There are whole asset classes where the natural buyers have essentially disappeared. Heard an interesting statistic at a Deutsche Bank Global Markets Conference earlier this year about sort of the reduction in the role of hedge funds in the industry from sort of peak to trough. Hedge funds had about $2 trillion of AUM, went down to 1.2. But the more interesting number that came out of that was that their leverage went down from sort of 4 to 1.2 as well. So in terms of actual market exposure, you're talking about sort of $8 trillion worth of market exposure to something like 1.2. And hedge funds were large players in significant parts of the U.S. fixed income market. And you now have, total segments of those markets where, if you were to model these securities using normal assumptions, you'd find huge value. There are significant parts of the U.S. asset-backed market where, you can buy legacy floating asset-backed securities that have sort of 3 years to maturity that any reasonable credit analyst is pretty convinced is going to mature at par that are trading at 85. So ultimately, for those of you who are academics who may decide one day to study this, be very careful because you're going to get numbers of things that would have looked like obvious trading strategies, but which would have never been implementable because you wouldn't have never been able to buy those things. That is still a very sort of concerning aspect to us. In particular, when we do simple things like valuations. There are significant parts of the U.S. market out there where the valuations that are publicly available are still somewhat questionable. And the last thing I wanted to say is that basically, this is obvious sort of commonsensical comment, but unwinding huge amounts of leverage takes time. And this was an economy that was clearly characterized by huge leverage, sort of in two waves: leverage created in the equity markets in the late 90s, and then in the real estate market later on. And it's like drug addicts going through detox. First of all, it's painful, and second of all, it takes time. So, thank you very much.
Thank you. Floyd?
Thank you. I'll just, before I start my presentation, I'll say, I hope you will tell us later what that asset class with the 59% return was. I want to thank Professor Patrick for inviting me. When the first panel began, I sat back in my chair greatly nervous when Professor Glasserman began to describe the worst journalism he'd encountered in this area, and I was pleased to not hear my name. I think the biggest failure of journalism in this, which is not the topic I'm supposed to discuss, not the topic I will get to in a second, was that we didn't pay enough attention to the details of structured finance when it was going on. I did not understand, and I should have understood, that somehow we were taking double B assets and concluding that most of them were AAA, that most of the risk in them could be taken on by triple B people. Most of the money could be put up by AAA investors. And it didn't work out. It seems to me that if we'd understood that, we would have been a long way toward writing about it. The question this panel was asked to discuss was, why was the financial crisis less enduring in some other countries? And I've got a few ideas I want to throw out. I can't prove any of them. First of all, it helped if there was not a property bubble in a country. And the reasons there were and were not property bubbles, were large. They included the financial structure, the willingness of banks to hand out mortgages, other things. Second one is, it helped if there was better regulation. They had a property bubble in Spain. The Spanish banks, the big ones anyway, seem to have come through this very well. And the Canadian banks seem to have come through it well, too. And I think one answer to that is that the regulators were insisting in ways that our regulators were not, that during good times, they accumulate capital and keep it. Our banks, our Wall Street had preached a gospel of shareholder return, get the money out to the shareholders, and they didn't have a lot of money around when it turned out the profits had vanished, and some of the profits they had previously calculated may not have been real. Another issue was, it's good to have a smaller financial sector at this point. The obvious proof of that is Iceland, which, many financial sectors had to be bailed out by the governments, and it's nice to have a big government relative to the size of your financial sector when that happens, and Iceland had the opposite. A fourth one, I think, is that international openness could be a problem. Again, the previous speaker referred to how the Belgian banks had done. This was also true of some German banks. Germany had no property bubble, but they had some banks in trouble because they had bought a lot of the fine assets that we had produced here in New York, and we are grateful for that. But it may not have been a good idea for them. I think tied to the regulatory question was a willingness, which was captured in Basel II, to assume that models were reliable. I think a lot of people came to accept models without the caveats that the model makers knew and admitted were in them. And I spent some time thinking why this is. This is anecdotal at best, but maybe it has something to do with the fact that the senior managers had not learned quantitative finance back when they were young. Somebody referred earlier to the idea that quantitative finance was under 30. I went to Columbia Business School. I graduated nearly 30 years ago, and if they were teaching any quantitative finance, I managed to avoid it. One example quickly, which is not relevant to countries, but in the late stages before the stock market collapsed, I happened to stumble across the Pension Benefit Guarantee Corporation, which, as I'm sure many of you know, is the operation that promises to pay out pensions in this country if a company goes under. And the guy running it then, the politician running it, had a model and an analysis which proved that stocks were always less risky than bonds. In the worst possible scenario over 20 years, stocks would produce a better return than bonds. Therefore, of course, one should have all stocks. And I talked to him about it and was just amazed at it and wrote a column mocking him, which did no good. The good news, by the way, for taxpayers is that the government moves slowly, and he was unable to get this strategy implemented to the extent he wished before the market collapsed. But from his point of view, a 1% probability was the lowest probability he need consider. And, someone commented I think someone commented that we're having, these financial storms every few years. Another issue that I think was important in protecting countries, and this is not, this is so alien to the conventional wisdom that has prevailed in Western markets, is that competition really hurt. If you had a competitive financial system, it was hard as heck to avoid making some of these mistakes because they worked for so long. I don't think if the people running Merrill Lynch had awakened one morning in 2005 and said, my God, this mortgage market is getting kind of odd, let's get out of it, they would have underperformed ridiculously for the next few years. And I doubt they would have had their jobs when they were proven correct. It just wasn't going to work. It is true, Mr. Daniel from Goldman Sachs, who was on the previous panel, I was very impressed with. I had not known him before. But one thing he said that he said that he didn't think people were really thinking about some of the risks. I think people thought about them, and I think the people who thought about them were discredited. Bob Shiller, a man I have great respect for, the Yale economist who was referred to earlier, he was warning about irrational exuberance in 1996. He's the man who gave the phrase to Alan Greenspan. His timing was horrible. His insight was correct. There is an old cliche on Wall Street. I've spent a lot of years watching markets that the graves of Wall Street are filled with those who were right too soon. And, this is what happened to people who were bearish. They went away because they were proven wrong. Discrediting bears is a requirement of any bubble. It happens before it ends. Finally, I think it helped countries if they'd been through a recent crisis. Professor Ito referred to something along those lines. The Asian countries learned some lessons from 1998. And blessedly, the lessons they learned proved valuable, or at least the answers they came up with proved valuable this time around. They learned that it was nice to have a currency that was, if anything, undervalued, because then you could build up foreign exchange reserves, which could come in useful if things went wrong. They did. That in itself may have contributed to this crisis for the developed world, but it left them in a much better position. So, finally, I think that the countries that did the best job of staying away from some of the conventional wisdom of Wall Street ended up doing the best.
Thierry?
Yes, thank you. I would also like to thank you, Patrick, for inviting me along to this distinguished colloquium. And as always, the one who goes last will be echoing some of the things that have been said, but I'll try to see if I can put a slightly different point to it. And I'll be focusing on this question of why the Japanese banks seem to have suffered less from the crisis. I could start with a notion that is becoming more and more popular in Japan, that Japan is simply the Galapagos Islands of the world economy, and therefore it is simply natural that they are different than the others. Commissioner Sato, now former Commissioner Sato of the Japan FSA, recently was at a Harvard Law School conference. He gave 3 reasons why Japan suffered less. First, a lack of orientation toward innovation. Secondly, a priority placed by the banks in improving their financial soundness, and of course that's related to the problems that they had in the past. And third, and he was modest here, improved risk management as well as improved regulation. I think there is something to all of that, but I will take a slightly different tack on this. Takatoshi Ito raised the issue of whether the Japanese banks were either backward or advanced. I would argue that they were neither backward nor advanced. In terms of not backward, futures, options, securitization, CLOs, risk models, use of balance sheet models for managing banks, such as the Moody's KMV framework, which uses default probabilities. Japan, the first major country to adopt Basel II. One cannot argue that the Japanese have been backward and have simply operated in a backwater of global finance. But at the same time, I would say not advanced. They have not been on the leading edge of innovation. They are not major players in terms of trading securities and other financial assets around the world. They really could not lead in the originate to distribute model that was so important here in the United States. And in large part, I would argue that that's due to a human resource issue. Japanese banks and other financial institutions still largely operate in a system that is based on seniority, in which people move in lockstep, in which there is not always specialization. You get rotated from time to time. And often the best and the brightest, those who are most adept at trading activities and other activities, end up at foreign financial institutions where they can find much faster promotion and much greater remuneration. Which is not to say that there are not enough smart people in Japan. I recall the analogy, the American collegiate analogy that Yoke Kurosawa, the great international banker of Japan of the 70s and 80s, he was president of the Industrial Bank of Japan. He used to lament that, at IBJ they had too many national merit scholars and not enough NCAA champions. And that's why they were continually outrun by the foreign firms. My own thesis is that the Japanese difference is related to 2 factors. First, the trauma, the real trauma of the banking crisis. We have to recollect that this crisis really extended from the middle of the 90s to really didn't end until 2003, and there was still some more of the effects of it in as late as 2004 and 2005. And I would relate that trauma to my own personal experience. So I was born and raised in New York. I left New York in 1983 I was with Morgan Stanley at that time, to work overseas. I spent 25 years working in Europe and Japan. Came back to America in 2008. Did I feel out of place? Not at all. I found here in America the economy of Japan of the 1990s and public policy of France of the 1980s. So I was right at home. Right at home. I went back to some of my old habits, and one was regularly going to run in Central Park. And one fine August morning, I was out running early in the morning, minding my own business, and as I was crossing right at the level of Cleopatra's Needle to go to the reservoir, I was hit from behind by a cyclist without a helmet on a mountain bike, hitting me at top speed from behind, knocking me to the pavement. Rather a traumatic experience. And fortunately, I ended up with about half a dozen cracks in my humerus. He ended up with a broken arm and a broken hand for his good work. But the injury was nonetheless very serious. So, what's the analogy? Well, first of all, as you can imagine, I wasn't doing much running right after that. Certainly not running hard, and for quite a period of time, not running at all. And I think the analogy to the Japanese banking system is that we have to recognize that Japanese banks really did stop running for quite some period of time. They withdrew from international activities. They reduced their risk. They had to spend all of their time fixing problems at home. And they were not out there running in the global financial markets. And the second is what I'm experiencing now, that I'm now finally, a number of months later, having recovered, out there running, is that you worry about those cyclists out there. And you're thinking about that as you're running again. And I would relate that also to the Japanese banks. That experience, and Takatoshi Ito started to refer to it, but that experience in the minds of bankers has been very significant. And let's go back to the history. You know, Japanese banks, if you go back to the 1980s, into the early 90s, participated in every global financial extravaganza known to man. They bought, you know, the junk bonds, they bought perpetual floating rate notes, remember those? They bought all kinds of derivative-related securities of huge complexity. But they really largely stopped. And I think that that is a very, very significant factor. Now, if I could give you the counterexample to perhaps prove my thesis, and I'm a little bit loath to mention a name, but I think one has to make the example work. There is one bank that is the counterexample, and that is Norinchukin, the Farmers Bank of Japan. They did not have a traumatic banking crisis in the late 90s and early 2000s. They went along just fine. But what did happen to them is they started, because they had lots of liquidity and they were in reasonably good health, they created an enormous portfolio of alternatives and private equity and hedge funds and CLOs and other securitized products, and took an enormous bath, huge losses in 2008 as a result of all those investments. They hadn't suffered that trauma. They certainly weren't worrying about those cyclists, and they ended up with quite an enormous financial loss. The second factor is, I would say, the increase of transparency. And this is largely a result of the efforts of the FSA. And I think one footnote in the history is that, as Takatoshi Ito mentioned, Japan undertook a major reform. They ripped away from the Ministry of Finance, the most powerful ministry in Japan, all of the financial oversight and regulation, and put it in a new institution, albeit with a number of people who came from the original Ministry of Finance, but created an entirely new system. And they did it within a period of 2 years. I mention that, I underscore that, because we are having a discussion or a lack of discussion in Washington in which we say it would be too hard to do that. And yet Japan, whom we often criticize for not doing difficult things quickly, did indeed do that right in the middle of a financial crisis. But in any case, that reform was indeed quite successful. And it has been particularly successful in creating an enormous level of transparency on the part of Japanese banks. Go back to the history. In 1992, this is true, what I'm about to say. In 1992, Japanese banks were not required to disclose their non-performing loans. And so they didn't. And the rules of, the NPL definition was rather lax, and the inspection system was clearly lacking. By 2006, we have a very robust inspection system, very well-trained inspectors who know what they're doing, and significant disclosure. Example, as the problem of all these securitized products unfolded, the FSA required Japanese banks to disclose their structured products openly, and within a very short period of time that was done. They were there on websites, available for everyone to see. And this increased transparency, and I relate it to one aspect of Japanese society. I don't want to get into a long sociological discussion, but Japan is a society, not a Christian society that believes in sin and redemption, but one that is based on shame. If you have to disclose, you have the risk of, therefore, of shame. A lot of disclosure is the way to get around the problem of covering up issues. This has become the standard, and that very now increased level of transparency, I think, is very important. So, to my mind, what makes the difference is a combination of psychology and human nature, and that is what has made, I think, the Japanese experience of the crisis quite different. Now, I'll conclude on two other points that perhaps can make the discussion more lively. Are Japanese banks out of the woods? Not at all. One thing to point out is that in spite of the fact that they certainly didn't have the kind of crisis we had here in the US, the major Japanese banks at the end of their fiscal year, which was March 31, 2009, did have substantial multi-billion-dollar losses, each of the big banking groups, the top three. Why is that? Well, they had a lot of loan losses, but more significantly, they had huge losses on their portfolios of equities. Japanese banks still have substantial amounts of equity in their customers, so-called cross-shareholdings. The problem of the Japanese banks today is that they don't have enough common equity relative to the size of their balance sheets, and they still have these very high levels of cross-shareholdings. I would argue they shouldn't have any. And of course, the economy is not doing well. So Japanese banks, in spite of the fact that they did better out of this crisis, I think still have some significant issues. The last issue I'd turn to is that of looking at quantitative models. Japanese banks, certainly the bank I led, and banks around the world have used quantitative models, for example, to look at their entire balance sheet. The most frequently used is that the KMV framework. And what that KMV framework does when you look at it for a bank is it aims you toward diversification. Let me tell you that what happened at the end of 2008 and 2009 is that everything correlated to one, and it all went down, and the model was really quite useless. What should we learn from that? My own view is that we should be studying Minsky a lot more because he has described the nature of this process in which, you go out, financial institutions go out, they make money, they're doing well, then they have more leverage, then the herd follows them, and then it all seems to go the wrong way, and we all start all over again. Perhaps if some of this trauma that I described becomes more important in all of our minds, of those of us who are operating the financial markets, and we increase the level of transparency to a much greater degree, which unfortunately, whether you like it or not, does mean much more rigorous, tough-minded regulation, then maybe we can avoid that cycle of Minsky. Thank you.
Thank you. Bruce asked me to speak a little bit about liability issues as it relates to the crisis, and I have 10 minutes in which to do that. So I'm going to do it. I'm going to talk about very quickly about four different issues. One trivial, one operational, one interesting and systemic, and the other, I think, interesting, but less legal going forward. The trivial one, which I will deal with quite quickly, is the notion that there are serious liability concerns that relate to people who both either devised models that were traded on or senior managers who either followed the herd or weren't smart enough to notice that the circumstances that underlie the market had changed. As a practical matter, liability is not a significant concern in that respect. That's not the way in our system we handle disciplining bad business judgment. For better or for worse, on balance, we don't. The second issue, which is more fun, more interesting, and I think more significant looking forward than it's been, is the operational problem. That is, managing a diversified financial institution, which on the one hand has a very significant proprietary trading desk making its own judgments on the one hand, and on the other runs a significant asset management problem. We saw some problems along those lines in the current crisis, and there's litigation playing out. The notion that the trading desk can have a point of view that is different than their asset managers, looking forward now, not so much looking at the current litigation, that's a bad bet. Because I think the way to think of the legal system in this world is much like poison ivy. The first time you're exposed, you don't get much of a reaction. The second time you're exposed, you get a big one. So the next round of, my prediction is the next round of conflicts internally between the viewpoint of the proprietary trading desk taking a position with the institution's own capital and the position that the sales force are taking with respect to the asset management side is going to get treated a whole lot tougher than it got treated this time. Prediction, everybody's got a point of view. The third point, the interesting and systemic one, sort of runs from the disclosure issue. And it goes to the circumstances under which the securities regulatory system requires disclosure on the part of financial institutions. Our thrust is to enable trading markets. That is, we expect disclosure to be made quickly. We, through the management, the MD&A associated with each quarterly report, we want management to say what they think. And I'll suggest to you that the set of disclosure rules that you'd use to support a deep trading market is different than the set of disclosure rules you'd want to do if you wanted to empower a regulator to manage crises. What you don't want in a crisis is suddenly to tell the world that this is a real problem, because then you're going to get a run. If you're trying to broker a merger that has to be approved by the shareholders, too much disclosure could get in the way. I can formalize that tension in terms of the role of the trading market in the US as opposed to other countries, but there's no way around the tension. That is, the speed of disclosure and the capacity of any regulator to manage a problem run into each other. And this comes to the last point, I'll even be a little earlier, and the more interesting one, and it builds, I think, off of Floyd's point that competition hurts. The debate, we're having a kind of one-sided debate about the future shape of regulation. And I say one-sided because I see the ghost of Edmund Burke walking through the halls. Conservatism restrains excess, and it prevents unintended consequences and grief, and that's right. But or to put it in the current terms, it avoids systemic risk. Well, there's another kind of systemic risk which has tended not to get mentioned, which is when the ghost of Schumpeter walks out. A systematic reduction in innovation has another set of pain. And if you believe, as I do, that our government is, to use a behavioralist term, loss-averse because their constituents are, we run a very serious risk of building a significant loss in innovation into the regulatory system that comes out of that. Now, that's the easy part, right? Telling somebody they have to walk this very narrow line between Burke and Schumpeter is really easy. Trying to figure out what that line is really hard, and I'll close with one last comment about the nature of the analysis. As we've talked about moral hazard and systemic risk, we've looked so carefully at the incentives associated with actors in the financial markets, because that's where the Burke perspective will put you. I suggest that when we start thinking about the nature of the regulatory institutions that we're developing, we ask ourselves carefully the same set of incentive questions with respect to the regulators going forward, because that's the issue, that underlies the systemic risk from an innovation perspective. Those questions, when we think about how we incentivize our regulators, how we promote them, what's political positions and what's not, are relevant to that issue. The last point is, I opened with a reference to Floyd. I'll close with one. Competition hurts. That's absolutely right. Let's not forget General Motors. the lack of competition also hurts. Walking the line between them is really, really hard. We'll have questions now, and if it would be wonderful if you'd state your name and affiliation before you spoke. Sure, go ahead. Anyone want to? Sure.
Well, I would say that the difference with this latest crisis is that, and I'll start again with Japan, in spite of the fact that the Japanese banks did not have the kind of cataclysm that large U.S. banks had, the global interbank market was closing down. The foreign exchange market was experiencing extreme difficulty. And, we came extremely close to a complete breakdown of the entire system globally. So that, of course, reflects the significant presence of U.S. institutions and the very significant weight of the financial system in America relative to the U.S. economy and its impact on the global economy. But this one was way off the charts and almost took all of us with them. I mean, each day in Tokyo, we had to be looking, not just my relatively small bank, but other banks were looking at, would there be the interbank activity necessary to roll over your foreign currency positions? That's the state that we were in October, in November, in December, because you have to get through the year end. That's what we lived through.
One big difference between the Japanese and Asian banking crisis and this crisis is that the Japanese and Asian banks held those non-performing assets on the balance sheet, while the Americans securitized it and marketed to the rest of the world. So naturally, those toxic assets, when it became toxic, apparently, was crisis everywhere. Who bought those assets? So securitization made it much easier to spread the crisis to the rest of the world.
One of the things I don't think we talked about in terms of how the markets have functioned in an era where models have become more and more prevalent, and it's something that I found very symptomatic moving from the sort of banking broker-dealer side to the asset management side over the last 10, 15 years, is asymmetry of information and asymmetry of resources. The amount of sophistication that you have on the distributor side, broker-dealers in particular, versus what you see on the buy side is a gulf. And even in asset management in general, you've got a huge gap between sort of the more sophisticated and the less sophisticated ones. And so in a large number of cases, this was the sort of people not knowing at all what they bought. And no process, lack of process in terms of sort of approval of, what are eligible securities, et cetera. I mean, I've seen a number of firms now where, processes have been put in place, and, if you can't explain to the chief risk officer what you're buying, you're not going to be able to do it. But, there are a lot of firms where that doesn't happen. Either no time, no resources, the pressures of sort of competing in the marketplace. A comment you made, I think, reminded me of the one of Chuck Prince, you had to dance until the music stopped. All of those pressures, contributed to that as well.
I can be the last one to react. What Professor Ito just said about securitization was true, but the fact that was believed by American regulators proved to be disastrous. Alan Greenspan was confident that this had enabled the risk to be transferred to places that best could handle it. It turned out a lot of the risk had stayed with American banks, or in some cases come back to American banks, and they didn't know it. And finally, I couldn't agree more with, I was very impressed by Professor Gilson's comments at the end about Schumpeter and Burke. I think you can see that in the history of the FDA. When I was a very young man, there was a woman at the FDA who saved America from thalidomide, became an incredible national hero, and people later complained the FDA became too resistant to new drugs, which is probably true. And finally, an assumption of our regulation in the last 50 years, which ought to be under attack, was that there were two groups of people, investors. There was the retail investor, people like me who needed protection of the government. And there were the sophisticated institutional investors who could look out for themselves. And it turns out, what my colleague on the left just said, people didn't know at all what they bought. Maybe they weren't so sophisticated. Thank you.
Other questions? Let me throw something out to the panel. We focused on Japan. My recollection is that both Canada and Australia also avoided some level of the grief. Any sense of how they got lucky? This includes the audience.
Actually, the only factor that I could point to in the case of Australia is not necessarily related to purely their banking sector, but the structure of their economy as well. So, Australia has definitely benefited from sort of continued demand for raw materials coming from Asia, and therefore that has softened the blow to a certain extent in the Australian economy. But it is correct that you did not see sort of large Australian and Canadian names in sort of the front pages of any reputable publication on credit issues.
I mean, I think I would certainly agree with that. I also think that in the case of Canada, you have a mortgage market that is a recourse mortgage market. So that's rather not all states in the U.S. are non-recourse, but many are. And I think that makes a difference too. If you look at Spain, which Floyd referenced, they have the ability, banks have the requirement and the ability basically to make counter-cyclical provisioning. So times get better, they do more lending, they need to put up more provisions. And the Spanish regulator took a very tough stance on things like SIVs and other off-balance sheet instruments that the Spanish banks could not circumvent. So there are a number of different things that you can find in different jurisdictions.
Actually, comment about sort of the cycle of recovery made me think of an interesting anecdote. When we were in the midst of the crisis, and we had daily senior management meetings where our economists would typically comment on their forecast. And this was sort of, in the gloomy days of February. Their perception was that the world economy would actually not recover until the U.S. economy did. And that was consistently so. And being sort of the only foreigner on the management team, I sort of, had the immediate, oh my God, how, home country based bias that is. And it's been true for the longest time. But my thought was, at some point in time, that's no longer going to be true. There are countries, whose middle class will now have grown to the point where, their internal engines will be sufficient to basically sort of, detach from the American locomotive. I'm not exactly sure it's going to happen this time, but at some point in time over the next 50 years, it will happen. And we're starting to see some of those characteristics by certain countries, posting more positive growth rates than the U.S.
It's coming.
Thank you. Very interesting panel. Two of the issues raised, one of innovations and incentives. And the question whether innovations can be good and bad. So ultimately, it really comes down, in my view, the issue of innovations comes down to an issue of what the incentives are within the system, as much as anything else, right? And you referred, Mr. Porte, I think, to this, you referred to the Japanese incentive system really being quite different. That's what it comes down to. But that is partly because the culture of the institutions and larger social capital type of things which are hard to reproduce. But what are its implications? What does it mean going forward for reforms in the United States of incentives? And that's what, in a sense, is one of the most difficult issues, as we all know.
Floyd, you want to take a crack at this?
Thank you.
Follow
Thank
this.
you. Well, there's as the question of executive compensation has been all tied up with that. It seems to me the reality is that the incentives weren't that bad at a lot of institutions that went belly up. The people at Lehman, the senior people, were required to hold on to their stock for a very long time. And they had every reason to protect that company from going under. And they didn't. I think incentives are overdone on the upside and the downside. We're told that we need to pay a CEO $30 million to incentivize him to do a good job, and I'm sitting there thinking, why? So I'm a bad one to answer this question because I have my doubts about incentives having been a really important thing, certainly at the top. At the bottom, they may have been. Certainly, there were a lot of financial institutions that were rewarding people for doing business, whether or not that business turned out in the long run to be profitable. And, that's making what you referred to at the beginning of your talk, the 100% loan to the man who is offering no evidence of his assets or income, it doesn't sound like you needed to have been at the top of your Harvard Business School class to figure out there could be a problem with that. But they did, but there was no, so incentives there mattered. I'm not sure where they matter other places.
So that's the Japanese connection again, that no income, no job, or no asset is called a ninja loan that originates from the Middle Age in Japan. The executive compensation, I think several issues are mixed up, and that got really made the public angry. And I don't mind, they earn high compensation in good times, but bad times when it belly up and government money comes in, and I think that should stop any high compensation at that point when the government money comes in. The problem was that someone forgot to put the conditions on the capital injection. And Japan did it right. They tried twice, and the second time they got it right. That you have to have the asset due diligence, basically, which is similar to a stress test. And you need to have the resolution mechanism in hand to threaten the company to take the capital or not. And if they take the capital, all the strings should be attached. And U.S. didn't do it in the right sequencing, and they're left with the banks, which could say, "Well, you cannot, make me bankrupt, and you give us more capital, and we're going to pay the compensation. And so that was, I think, that made the public really angry. So I don't see any problem in compensation in good times, but you have to have the mechanism to stop all those compensation when the bailout is necessary. And I think the incentives that Mr. Porte mentioned is that incentives were wrong in Japan. And it is too much based on the long-term service to the company, and less tied to the performance. And that made the young people to leave to the foreign financial institutions where they couldn't wait. They became very impatient. They couldn't wait 30 years to have an interesting job and high income. So Japan is not the model for the innovations and incentives.
I think Floyd may be right that the incentives are probably overblown relative to the outcomes. But I think that the current situation we face in the U.S., I think that the concern that I have is that all of this discussion about compensation ultimately relates to the issue of public anger. It's not being intelligently addressed. If we had another crisis tomorrow, we still don't have a mechanism in place to unwind a complex institution, and that public anger will only be greater. And I think one of the lessons from the Japanese experience is, lots of reasons why it took a long time, many different reasons, and people can describe cultural reasons and all the rest, but one very basic one is that when you had the initial crisis, which was over something called the Jusen, which curiously enough were housing loan corporations that got way out of control, making 100-year mortgages. You may have had an income, but the mortgage was 100 years. Who's going to worry about that? And all sorts of other speculative real estate. The government mishandled that, and the public anger was so enormous that they ended up having to delay the response for over 3 years. Very costly 3 years of delay. So I don't think that we should underestimate the issue of public anger as it relates to this as we look ahead. The other aspect, though, is related to the capital markets, and it's what we've said in several different comments, and that is that, yes, it's indeed true. If Chuck Prince had said, hey, I don't care, music is still going on, I'm going to the sidelines, how much time, I'm finished, we're not doing any more of this, how much time would he have been given? 2 quarters, 3 quarters, maybe a year, but then he'd be gone. He'd be gone, because that's the way our capital market works. And I don't have the answer to this, but I think that that's an issue that we have to grapple with.
That's actually a macro incentive problem. One of the problems is quarterly earnings. I've always had the desire to take a company private because I think that too many decisions.
I'm with you.
Too many decisions are based on quarterly earnings, and I think Professor McKenzie was talking about it earlier. How many traders basically, have trouble keeping a position that they think in the long run makes sense, but their day-to-day P&L is negative. The whole system in which we operate, does not favor sort of long-term views, and that's actually not even just true for financial institutions. I think it's true for American industry in general.
I'd just like to bring this back toward the issue of quant models, okay? If I understand you folks correctly, what you're basically saying is that all the capacity to create and understand these models was on the sell side, and there was virtually none on the buy side. Is that the sense of what you're saying?
No. I didn't go to that extreme. I said there was definitely in general, there's an information asymmetry between the two. It is skewed, but I don't think there's none on one side. You actually, you do have some amount of movement, in the industry going from one side to the other. But let me give you an example of sort of models that give...
Okay, and then there's a second part of that question that I'd like to hear answered as well, okay? How did management of that asymmetry affect the outcomes in the countries you're speaking about that actually did well? Okay, because obviously a lot of people were dealing with that asymmetry, and it didn't work out too well on this side of the ocean. So what were the factors in dealing with that asymmetry that made a difference in the countries you're familiar with?
Okay. So in answer to your first question, I want to give you a live example of sort of this asymmetry related to the actual functioning of the markets. Take multi-factor models that are widely used in the asset management industry. In the equity space, since the markets are actually exchange traded and the information is widely available, there are third-party vendors out there that create very reasonable equity factor models. Axioma, Barr, Northfield, and they're the standards in the industry. Go to fixed income, and fixed income is an over-the-counter market. Who had the top model in fixed income? Lehman. Basically because they had access to the underlying information that would actually be used to model that market. And that's probably the jewel that sort of Barclays got when they bought Lehman, is the original Lehman point system. So there, significant asymmetry. Again, no other firm has managed to crack the fixed income analytics market the way that broker-dealers actually have had control over them. So I don't know if anybody has any comments on the second question.
Well, I'm not sure about the second question, but the obvious answer to this information asymmetry is credit rating agency. It's supposed to be a neutral appraisal of how trustworthy the securities are. You cannot expect all the investors to know the underlying assets and so on. You cannot blame the buyers to not examine, not knowing those assets. They just trust the seal of approval to pay, right? So that's the function of credit rating agencies. But as we saw in all the papers and newspapers now. Make it clear that the credit rating agency failed. Not just failed in calculating the assumption, the probabilities, but they were in the same group with those issuers, because the issuers invited the credit rating agency. How many securities should we throw in as diversified assets to get AAA? Give us just enough to get over the AAA, right? Rating of the corporate bond, you cannot split up or mix up. It's a corporation, so AAA is AAA and single A is single A. But in the case of this structured assets, you can throw in several things and clear just enough into the AAA. So the credit rating agency was, part of the group. And this is now clear, and we have to do some regulations about credit rating agency to make more separate between those sales, research side and sales side. And again, going back to those models, credit rating agencies have to have the independent neutral model to make it more neutral and trustworthy from the investors, and that's another aspect.
I'm glad you brought up the credit rating agencies. I think they had many of the same problems. If Moody's, to pick one of the three at random, had discovered in 2005 that the assumptions behind the CDO ratings and the MBS ratings were baloney, the result would have been that Fitch and S&P got all the business, and the guy at Moody's who discovered that would have lost them incredible amounts of money. The investors did have responsibility to understand what they were doing. No, they couldn't look at all the underlying assets, but they could have sampled them. I would commend you all to some suits filed by MBIA, which I wrote about a few weeks ago, suing Wall Street firms for having misled them about the nature of the securities they were guaranteeing. And in it, they say that given the low premiums we were charging, we couldn't possibly have been expected to look at the underlying collateral. And therefore, all we could be expected to do was to depend on the Wall Street firms that were, whose assets we were guaranteeing and the rating agencies. Well, okay. That was obviously a bad business model, and we know what happened to MBIA. I think the buyers had a responsibility to understand a whole lot more than they did. And I also think, though, that the information asymmetry, came back to haunt Wall Street, because my impression is, and there are people in this room, I'm sure, who know far more than I do, including people on this panel, that some of the firms in their own risk models tended to assume that if you had a AAA security that was floating, that you had a riskless security, and therefore you could pile up as much of it as you wanted because there was no interest rate risk, it's floating, and there's no credit risk, it's AAA, so what can possibly go wrong? Those were the people who, supposedly had the better information.
What was the company that filed suit?
MBIA, the bond insurer.
Yes. Okay.
This is a large question, but I would like to hear your opinions about what, if you were designing a regulatory system, what a couple of the main characteristics of that system would be, and then if you could, what a more realistic political, given the political situation, what a more realistic result is going to be. Thank you.
Who would like to touch that one?
I'll touch the first question in a very generic sense. It's actually one of the risks that I continuously worry about the organization as a whole, and it's groupthink. I think that a lot of organizations get themselves into trouble when they basically, hire people who've been trained in the same schools, have done the same stuff, and basically, confronted with a common problem, always come up with the same answer. So what's true for organizations is actually true for regulators as well. If you actually look at, the various regulatory bodies in the U.S., you've got one that's staffed with lawyers, you've got one that's staffed with economists, and that's not a good model. One of the things I would, advise any designer of the regulatory framework is to make sure that, you've got the people who sort of, don't fit the model very well, and who ask, the different question, because we don't get a lot of that. And I didn't mention any names, as you can see.
No, I think the regulatory system, I would prefer the single comprehensive regulator, or maybe 2 or 3, but not the 5 or 6. I think whether banking and others should be separated, FRB and others, that's one model, or you could have FSA type model. But a lot more consolidation in the US is necessary. And second, I think the resolution mechanism for large complex institution should be in place. Otherwise, government doesn't have the leverage to expect the financial institutions in trouble to behave the way that we want them to behave.
Let me just make a small point. I don't disagree with the direction of large-scale reforms, but I want to talk for just 1 second about the importance of plumbing. One of the things that we've heard over the course of the morning was that there are at least half a dozen things that we've identified that if only that one thing had worked, it wouldn't have happened. And like most large disasters of complex systems, a whole lot of things have to fail at once. So putting aside for a moment the more difficult and the important things like unwinding large institutions, I'd also look at a set of what I call plumbing issues. I ought to be able to tell when I look at a set of securitized assets, however, whatever level it is, I ought to be able to trace the underlying assets. That wasn't the case in many of these, not because anybody did it on purpose, but because there was layered and there was no coordination. Markets, one thing markets don't do well is solving coordination problems. So a set of things that the government can do, which I don't think is politically controversial at the level of the larger issues, is simply provide the coordination in making sure that whatever the instruments are, we can see through them. What kinds of disclosure, again, those may not be the particular items that will keep the next one, but every piece of plumbing that we fix is a potential way of stopping the next one that we can't anticipate. Okay.
If I can just add one thing on regulation, everyone seems to agree that we need fewer regulators, and heaven knows the OCC should go away based on its history, but not the OCC, the Office of Thrift Supervision, the OTS. But one of the problems, you have regulatory capture issues, you have regulatory arbitrage issues, but you also have the fact that it's very hard, as a man you may have learned about in Sunday school once said, no man can serve two masters. We're seeing that right now in spades. The bank regulators, confronted with the issue of accounting, desperately want accounting that will make their charges look good. Because if they don't, it becomes much harder for them to actually make them good. And the SEC looks at it and says, we want truth. People should know if they're getting in trouble because we won't avoid the next crisis if they don't know that. And I think it's sometimes nice to have people with differing perspectives running around.
Great. Thank everyone for the panel for their great job, and everyone who came here today. Hugh, Patrick, and I were very pleased by, I know, the people who helped us out on the panel. I want to say that Floyd wrote an article, I think it was probably over a year ago, that one thing we know for sure about the next financial crisis is it's not going to look like the current financial crisis. And that probably remains true about these things. And it's also a bit like an Agatha Christie novel. There's too many suspects in the room, for the murder. And I look over at Paul occasionally, and I'm thinking, did financial engineering slip out the door on this one? And it by and large did, in my and probably rightfully so on being culpable for this action. But it does raise the issue of what really is going to be the consequences for the regulation or for risk management, or who bears responsibility. I do think there's a huge separation between social and private value, which is causing a lot of this trouble, and the amount of U.S. government bailout, or even the usual provision of social risk provision in the U.S. Points in this direction, which is quite important. When I listen to the financial engineering discussion about better models of data, we all agree upon that. We all love data, and making those things work better is great. But really, it's the issue of financial engineering leading to models, or financial innovations we're talking about here, these models, which themselves become problematic and to whose gain. And what do you teach people, our students who are studying financial engineering? Do they bear, should we say, nothing to them about their possible consequences of this engineering which they are involved in? And I think that's remains large issues for us to think about. Final thing is Donald McKinsey is very provocative and did a great job. It's quite performative, Donald McKinsey. And I was thinking about, I was talking to a bunch of people from hedge funds recently who are saying they're using all kinds of things. Behavioral finance is being built into these models more. One hedge fund actually using content analysis of CEO speeches. I'm not sure what value that could be, but it could be valuable in trying to predict future moves. And then I was wondering, maybe they'll be reading Don McKenzie's articles and building them in, and kind of the performativity of Donald McKenzie himself as he writes these things. So Donald, you may not be escaping full the full repercussions of your theory as you walk forward. Thanks very much for all of you. Really enjoyed the day, and great, Ron, for your help on this. Thanks.